It's a great pleasure to moderate this first panel, session. So I'm from SRK, a sustainability consultant, and this session is on sustainable mining company case studies. And our first speaker is Yulia Chekunaeva from EN Plus Group, and I believe Yulia is going to tell us about EN Plus's leading initiatives in ESG. Please go ahead, Yulia.
Good morning, colleagues and friends. I just by the virtue of this magical technology, I see many familiar faces, and that's pretty unfortunate that I'm not with you in person in the room. So I'm sticking to the virtual world, and I hope that technology would not let me down. Arthur and organizers actually asked me to give a top-down perspective on what climate change may mean potentially for the metals and mining industry. So the upcoming presentation is my personal attempt to synthesize into 7 minutes a global phenomenon and its implications for the largest industry there is. And then during the panel discussion, I would be more than happy to share with you what EN Plus is doing in particular when it comes to climate change challenge. So any errors and opinions in this upcoming presentation are entirely my own. So let's begin with the basics. The world consumes a lot of metals, as you all know. Each of you is consuming 350 kilograms of metals a year without noticing it. And the metals consumption is growing in line with GDP and population growth. So in 2015, 196 governments pledged in Paris to decarbonize amid the climate change challenge, and a very meaningful set of updated commitments came out from the recent COP26 in Glasgow. Yet, as shown on this slide, all elements of decarbonization are metals intensive. This would imply growing metals intensity of the economy as we're shifting from fossil fuels, which is good for metals and mining industry, definitely. But what it also means that the source of emissions would be transferred from fossil fuels to metals. And every metal production implies more CO2 emissions than actual useful metal extracted. And what is more fascinating, it is not only the energy infrastructure that requires metals, the so-called new economy does. So if you want 5G, you would need silver. If you want an electric vehicle, among other things, you would need lithium and cobalt. And do you want to charge anything? Well, you would need copper wiring for that. And even to produce these shiny objects that many of you have in your pockets or bags, I've read somewhere that it requires 17 different metals. Anyone knows what are the emissions of an iPhone? Well, 200 grams iPhone life cycle emissions are equal to 70 kilograms of CO2. That is about 350 times of the weight of an iPhone. So imagine what carbon footprint for a new large-scale industrial infrastructure. So in my opinion, the world needs low carbon metals, and this is a huge opportunity gap that the industry can address and must address. There is, in my opinion, a clear commercial motive for the industry to change by becoming a sustainable supplier. So it is not the question of purpose versus profits. I think that being purposeful in the sector means long-term sustainable profitability and actually would help mitigate risks of imminent changes that we are facing. So what are we facing in 2030? And on this slide, I make a conscious effort of imagining the future. So if your crystal ball tells you something different, I apologize in advance. I'm using framework of 5 industry forces and applying it to mining as it can be in 2030. And 2030 is the year when Greta Thunberg is 27 years old and is making her own consumer choices. So when old and new economy would come closer, and when, for example, via blockchain, any product available at Amazon or any other digital marketplace will have a carbon footprint label. This implies that there would be a price differentiation. A regulator can tax the entire supply chain at every point of entry. The financier can apply different cost of capital depending on carbon footprint. But even more so, as the boxes at the bottom of the slide show, climate change would be impacting our operations? Does our workforce want to work in hostile weather conditions? Do we have more frequent business interruptions, for example, due to floods or droughts? Can we obtain licenses for mineral extractions in the new areas, and so on? So what does it all mean for us, and why are we discussing it today? So what you would say, well, it is pretty easy, I think, to me, given that the industry has a relatively lengthy CapEx cycles. So to stay relevant and to be prepared for this 2030 future, we need to start changing, and we need to start change the way we operate. Many companies have already made statements that they have launched the decarbonization transformation or are about to launch it. This would require a lot of CapEx and a lot of R&D, because several technologies are non-existent or not existent in the scalable format at this point in time. And with the lack of clarity regarding the price of carbon and potential changes to fiscal regimes in different jurisdictions, it is likely that in the short term, it will pressurize our margins and impact returns to shareholders. Moreover, it seems, and this is my analytical background, current level of prices potentially doesn't induce the investment into new capacities or new technologies in introduction. What does it mean? Well, it means that somebody would have to pay for it, and whenever new investment is required, someone would have to pay, and it would be either consumer with rising prices, and there is research that shows that end consumer is willing to pay a higher price for low carbon products. And but then we would have to show as a sustainable supplier that we are delivering low carbon product. Or it can be an investor. Those guys would have to agree to reallocate capital, for example, and it's a massive capital that is required. For example, ArcelorMittal estimated a required investment of about $250 billion into new hydrogen-based steel mills and required infrastructure in Europe. And plus, as part of our net zero commitments, estimated multi-billion-dollar investment program into decarbonization. So I don't think anyone would have such money to build new capacities and, for example, maintain current capital allocation decisions when it comes to dividends, for example. And therefore, investors would have to accept potentially lower returns in the short term for the sake of long-term sustainable profits. And you would say, Yulia, this is all great, but if we don't have money and don't have visibility regarding pricing, what shall we do? Well, my personal opinion is that self-organization and diligent execution would lead the industry to the other side of the tunnel. And it all starts with the recognition that there is a challenge that we are facing. And it's not about being nice or ethical or jumping on a fancy bandwagon and using the relevant jargon. It's about commercial survival, which is going to be linked to the ability to maintain our license to operate as regulators are changing the environment that is impacting our business models. So we can analyze market as the slide shows. We can evaluate our performance and structure. So you have to measure your emissions, at least scope 1 and 2. You have to evaluate what are your sensitivities around carbon pricing for different scenarios, and what is the CapEx bill potentially that you would have to incur if the new regulation is introduced. And then obviously the only way you can be credible and accountable is by disclosure and compliance, and then tracking your performance versus what you have disclosed and what you have committed to. There are many still questions that are to be evaluated. We don't know if the price hike that is currently estimated would be sufficient, if investors would forego immediate returns, and does the sector has any equity value with with the carbon pricing because there are different scenarios? Would governments be more proactive and create incentivizing versus penalizing schemes for support of decarbonization? And would there be more trade barriers? And what does it mean from the standpoint of largest consumer of materials currently, China, their net zero 2060 commitment? Those are all the questions that I think we will learn the answers very soon, in my opinion, in the next 3 to 5 years. But as I said, as the CapEx cycle is very long for the industry, the time to act now, and I cannot finish it better than by sharing with you the wisdom of philosopher. The greatest thing in this world is not so much where we stand as in what direction we are moving. And I think that the direction of our travel is pretty clear into the world where we all fighting against climate change and contributing to mitigation of the drastic impacts there. So thank you very much for your attention, and looking forward for productive discussion.
Thank you, Yulia. Very interesting, and looking forward to chatting to you more a bit soon. Ayuna Nechaeva from the London Stock Exchange is going to tell us, I believe, how the London Stock Exchange supports companies with their disclosures, but please correct me if I'm wrong, if that's the...
Thank you, Jane. You're absolutely correct. I will talk about that and more. Good morning, ladies and gentlemen, distinguished guests. As Jane mentioned, I am Ayuna Nechaeva, I'm primary markets at the London Stock Exchange, and I'm delighted to be here in person, and also definitely want to say hello to those watching us live. Yulia mentioned a very important point about financing. Who is going to finance all of that transition? It was estimated at COP26 in Glasgow that hundreds of trillions will actually be required to enable this transition to low carbon economy. And I come here from the perspective of the London Stock Exchange, which sits at the heart of the financial markets here in the UK. So I would like to share with you my thoughts on how we can support that transition from the financial markets perspective. So climate change is a priority for policymakers, issuers, investors, and of course, the whole world. And for the world to achieve its emissions reduction target and to keep global temperature rise to less than 2 degrees higher than pre-industrial levels, a whole economy transition to low carbon is needed. With the global economy relying heavily on metals and mining producers to supply material for a wide variety of industries, as Yulia mentioned, that includes energy distribution, infrastructure, heavy machinery, automobile, technology sectors, to name just a few. It is hugely important to ensure that investors, regulators, exchanges such as London Stock Exchange, and consumers come together to support this transition to sustainable and low carbon economy. So the key word here is transition. From the public markets perspective, it is important to take companies in carbon intensive sectors, such as mining, on a journey to lowering emissions and being able to operate effectively in the climate smart world. What public markets do is that they aid transparency and encourage disclosure. Through public markets, investors are able to show what they're looking for, and actually by putting looking for in the company by putting their money where their principles are. Public markets also provide the tools for those companies to make the transition. For example, the London Stock Exchange has a transition bond segment, which opens a pathway to financing this decarbonization beyond traditionally green sectors. So that's the tool that is available to natural resources, metals and mining companies to raise capital specifically for those transition targets. This bond segment is actually part of the Stock Exchange's sustainable bond segment, where issuers actually have already listed over 300 bonds, raising over $95 billion. We're also supporting the Transition Pathway Initiative Global Climate Transition Center. And this enables the Transition Pathway Initiative to significantly scale climate assessments of companies, actually from 400 today to 10,000. It also provides this ability to expand the TPI coverage from equities to other asset classes, including fixed income. What we have touched as well today already is the TCFD, one of the standards for climate-related disclosure. TCFD stands for Task Force for Financial Disclosures, for climate-related financial disclosures. So why is it important? Disclosure plays an important role in this transition to low-carbon economy. It is crucial for investors who need to have the right information disclosed according to clear, consistent, and comparable standards. This is needed to actually assess the company's progress, stated progress towards their goals in the space of low carbon economy transition. So the London Stock Exchange has been supporter of TCFD since 2017. We think it's important to adhere to the same standards that we're expecting of our issues. So London Stock Exchange Group is a listed company, and we actually disclose against TCFD ourselves. The number of global companies, and actually, I would like to state actually from the very beginning that there is a huge number of mining companies that are listed on the London Stock Exchange. Actually, probably a quarter of all companies, operate in that sector. So, and these are big and small companies. A lot of them are in the FTSE 100 premium listed. Some of them are in the, on AIM, junior segment. So, for us, from the perspective of the exchange, it's very important to ensure that we're not leaving these companies behind. So I think divesting or encouraging over-regulating the companies to the extent that they can't cope is not the way forward. So we are actually supporting companies by giving them guidance and a number of tools for them to cope with that transition and the sustainable principles. So one of the things that I've mentioned is guidance. So it's climate reporting guidance, and it's based on the UN Sustainable Stock Exchange Initiative model guidance, which includes various principles around TCFD implementation, setting how to set net zero targets, and how to set how to set a trajectory towards net zero. We also provide training, climate reporting training. So there are interactive sessions available on demand that actually explain how to do this, and we do this in partnership with UN SSE. We also provide the climate governance score, which is TPI aligned. And Jane, you mentioned you've already had your client to look into that and who found that useful, and that's really important. So we enable our issues to understand how well they're integrating climate change into their business strategies, so they can identify credible transition plans. One of the things that we are, and I personally also asked very often, is greenwashing. They say, all of this good and, virtue signaling, all these good terms and jargon being used and, disclosing whatever is already available. How do we avoid and how we tackle greenwashing? And greenwashing is when companies say they've achieved certain sustainable goals or suggest that their sustainability performance is better than it really is. So we think that from that perspective, harmonized reporting standards are vital. So in addition to the guidance and TCFD aligned guidance, of course, we want to ensure that we work with other exchanges around the world to ensure global consistency and coverage. On the revenue side, for example, we use objective and transparent methodologies such as FTSE Russell Green Economy classification. And of course, you may be aware that the UK government is developing the UK green taxonomy based on the existing EU taxonomy. And that is actually directly aimed at facilitating sustainable investment and preventing greenwashing. So these are some of the really important aspects around greenwashing and making sure that issuers actually can credibly formulate their strategies. And before I wrap up, I wanted to flag London Stock Exchange's recent announcement at COP26 that we're developing a voluntary carbon market solution. So this is something that hasn't been done before. So this is aimed at accelerating the availability of financing to projects that would ultimately support a just transition to a low carbon economy. So this solution will provide capital at scale for the development of new climate projects worldwide, and also primary market access to a long-term supply of high-quality carbon credits. for corporates, for listed companies. So to sum up, from an investor perspective, divesting or shifting capital away from high carbon assets creates a risk that production simply shifts from one owner to another, or goes to a private market where there is less transparency. If high carbon assets are wound down irresponsibly, this also can create an energy shock and also have a disproportionate effect in the social sphere, so the S part of ESG, and especially in emerging markets. At the same time, if mining companies don't embrace regulation and if they don't start to action credible transition plans, they also risk being left behind. That is why London Stock Exchange encourages transparency and dialogue between investors and companies and supports more stringent regulation on climate reporting and transition planning, and provides a pathway for a transition to a low carbon and sustainable economy. Thank you.
Thank you.